Welcome back. It's really great to have you sitting down with us for another custom-tailored deep dive. We've got an incredibly dense, frankly, incredibly revealing stack of materials on the desk today.
Yeah, it's a heavy stack.
It is, and it's all built specifically for you listening. We're looking past the noisy retail crypto headlines today. The mission here is to decode the silent rewiring of global financial plumbing.
Right, the plumbing. And it is a fascinating collection of sources to pull from today. We're analyzing official press releases from the CFTC dating back to December 2025. We've got a rather bombshell white paper from Ripple detailing their blueprint for institutional trading, plus some highly technical GitHub specifications for a new protocol. It's called XLS66.
Oh, and don't forget that thick stack of macroeconomic analysis notes.
Right. The macro notes are key to tying it all together.
Exactly. So our goal today is to understand the shift toward what we're calling wholesale power, specifically how tokenized collateral is fundamentally changing the way institutions manage, trillions of dollars. But before we get into the weeds, I want to set the hook with something that seems to totally contradict everything we usually hear about digital assets.
Which is?
Well, the prevailing narrative is that speed equals value, right? Faster is better. But according to these macroeconomic notes, in the world of institutional settlement, slowing a digital asset down might actually be the secret to drastically increasing its value.
Yeah, it sounds completely counterintuitive at first.
Right. How does that possibly make sense?
Well, when you look at the actual infrastructure being built, the narrative shifts from just moving fast to something much more profound. It becomes about balance sheet capacity and structural lockups. But to understand that shift, we really have to start with the regulatory catalyst that made it all possible.
Okay, let's start there then. This major catalyst happened on December 8, 2025. This is straight from the Commodity Futures Trading Commission.
The CFTC.
Right. Acting Chairman Caroline Pham announced the launch of a digital assets pilot program. This program essentially allowed certain tokenized collateral, specifically Bitcoin, Ether, and USDC, to be used as collateral in U.S. derivatives markets.
Which is a massive shift.
Huge. They effectively replaced the outdated requirements from the Genius Act, establishing clear guardrails to bring these digital assets into regulated domestic markets.
And we should probably note here, just to be completely impartial as we look at these regulatory shifts, that while the sources do mention political context regarding the administration's goals for crypto,
Right, the political side of things.
yeah, we are simply analyzing the functional outcome of the policy. We're not endorsing any political viewpoint. The functional outcome here is that the CFTC actually gave the green light for tokenized assets to act as eligible margin.
And the industry certainly didn't wait around. Almost immediately, a U.S. derivatives exchange company named Bitnomial announced a historic milestone. They became the first U.S.-registered derivatives clearing organization to accept stablecoins, specifically Ripple's RLUSD, and they expanded their digital asset margin program to include XRP
Natively.
which meant traders could margin their positions with a USD-pegged digital asset and XRP, maintaining that blockchain-native settlement. So, okay, let's unpack this. For anyone not living in the institutional trading world, why is there so much excitement around the phrase margin collateral?
If we connect this to the bigger picture, it all comes down to a concept called collateral mobility.
Collateral mobility.
Exactly. To understand why this is such a breakthrough, you have to understand how frustrating the traditional system is for the people managing these trillions of dollars.
Right.
In traditional finance, especially in the repo market or derivatives, when there's a margin call, you have to move collateral to back up your trades.
Right.
And typically, this collateral is something extremely safe, like U.S. Treasuries.
Which are undeniably safe, but my understanding is they are painfully slow to actually move from point A to point B.
They are incredibly slow. The traditional system relies on this tangled web of custodians, manual reconciliation processes, archaic messaging systems.
So it's a whole ordeal just to move the asset.
Exactly. Moving that collateral can take hours, sometimes a full day. Now, during a normal Tuesday, that's just an operational annoyance. But during a crisis, it becomes a systemic threat.
Like what happened in 2019.
Spot on. Take the massive repo market spike we saw in September 2019. Repo rates, which are usually incredibly low, spiked above 10% because liquidity just dried up overnight.
So what actually broke in 2019? Was there just not enough money to go around?
No, the problem wasn't a lack of collateral in the world. The problem was that the collateral was trapped in silos. Banks had the assets, but they simply couldn't move them fast enough to meet the sudden, explosive demand for liquidity. The pipes were essentially clogged.
That makes perfect sense. The assets exist, but if they can't travel, they're useless in a crunch. So, how does bringing a tokenized asset into a derivatives clearinghouse solve a clogged pipe?
Tokenized collateral completely changes the physics of that system. It turns sluggish analog bonds or fiat currencies into programmable assets that live on a unified ledger. When you tokenize that collateral, a smart contract can verify the collateral's eligibility instantly.
Instantly.
Yes. Haircuts are applied automatically, and the collateral is posted in seconds, not hours.
Let me pause you there because the term haircut in finance always trips people up. When you say haircuts are applied automatically via smart contract, what does that actually look like in practice?
A haircut is essentially a safety discount. If you give a clearinghouse $100 worth of an asset as collateral, they might only credit you for $90 of borrowing power.
So they hold back $10.
Right. That $10 difference is the haircut, and it protects the clearinghouse in case the asset's price drops suddenly. In the traditional world, calculating and applying those haircuts across thousands of different clients is a tedious manual risk management process.
Lots of spreadsheets and phone calls.
Exactly. On a blockchain, a smart contract reads the market volatility and adjusts the haircut programmatically, instantly. It frees up literally trillions of dollars in trapped, idle capital that banks normally have to hold as safety buffers just because the old system is so slow.
Wow. If the underlying infrastructure is changing that dramatically, it explains the next massive piece of the puzzle from our sources. We are looking at a $1.25 billion move. In October 2025, Ripple announced the acquisition of Hidden Road.
The multi-asset prime broker.
And they rebranded it as Ripple Prime. Here's where it gets really interesting. Ripple dropped over $1 billion, and they didn't go out and buy a retail crypto exchange. They bought a prime broker. Why is prime brokerage the holy grail for a digital asset company?
Because prime brokers sit at the ultimate balance sheet choke points of the global economy. They are the credit intermediaries between hedge funds, asset managers, and the broader market.
They're the gatekeepers.
Basically, yes. They are the ones providing the financing, managing the margin, and handling the post-trade operations. By acquiring Hidden Road, Ripple positioned itself directly in front of the derivatives risk engine.
And Ripple laid out exactly what they plan to do with this positioning in a white paper titled The Blueprint for Institutional Digital Assets Trading. They introduced a concept they call the Digital Prime Broker, or DPB, model. The white paper offers a pretty sharp critique of how the current digital asset landscape functions, doesn't it?
It's a fundamental takedown of the retail crypto model. Right now, retail crypto exchanges operate in a way that traditional finance simply will not tolerate at an institutional scale.
Because they're doing too much at once.
Exactly.
Yeah.
They act as isolated silos. They bundle execution, custody, and credit all into one single platform.
The white paper highlights a massive flaw in that bundled system, which they label the free capital loophole. I want to make sure I'm grasping this correctly. In the retail exchange model, the exchange is often taking the collateral that clients deposit and using it as free working capital to subsidize their own operations.
That's right.
They are essentially getting 0% interest loans from their users.
That is the core issue. And it introduces massive, hidden counterparty risk. Think about it. The exchange is acting as the custodian of your assets, the venue where you trade, and the entity extending you credit.
So if one part breaks,
If their internal risk engine fails, everything collapses at once. We've seen this happen. This raises an important question for regulators and asset managers. How do you scale digital assets for institutions if the fundamental market structure is built on such precarious foundations? You cannot push $1 trillion through rails built for retail speculation.
the digital prime broker model is designed to unbundle all of that. It separates the execution venue from the custody of the assets and the credit provision.
It creates a hub-and-spoke model. The client only has to face one counterparty, the digital prime broker. The prime broker handles the credit and the collateral, while the client can trade across a dozen different exchanges.
You're no longer managing bilateral relationships and fragmented margin accounts all over the internet.
Precisely.
That structural shift connects beautifully to something we discussed back in our fourth deep dive together. We were looking at traditional foreign exchange markets and a concept called netting efficiency. The parallels here seem really strong.
The parallels to the FX markets are incredibly striking. In the late 1990s, the FX market was fragmented and highly inefficient, much like crypto is today. Then they introduced prime brokerage in a settlement utility called CLS, which stands for Continuous Link Settlement. Instead of settling every single trade gross, they moved to net settlement.
Let's break down that distinction for the listener. Gross settlement versus net settlement. If a hedge fund buys 100 Bitcoin on an exchange, and then later that day sells 80 Bitcoin under gross settlement, they actually have to move the funds for the 100 Bitcoin and then separately move the funds for the 80 Bitcoin.
Which is an enormous drain on capital and operational resources. Every movement is a point of friction. With net settlement, at the end of the day, or in this case, on a T+1 basis, the system calculates the overall exposure. In your example, the fund only moves the net difference, which is 20 Bitcoin. The Ripple white paper points out that utilizing a digital prime broker for this kind of netting can lead to an 89% reduction in gross fund movements.
An 89% reduction in actual capital moving across the wire. That is a staggering efficiency gain. You post your collateral once, centrally, with the DPB. That single pool covers your spot trading, your futures, and your swaps. No more fragmented margins sitting idle across 6 different exchanges.
It drastically reduces counterparty risk and operational drag. It is entirely about balance sheet efficiency.
If Ripple Prime is solving the risk of trading and netting, what happens to the assets themselves? That actually leads us into the third part of our stack of sources, which focuses on the evolution of the XRP ledger itself. There's a fascinating piece of news from TradingView featuring Ross Edwards, a Ripple executive.
Yeah, that was a key interview.
He explicitly stated that XRP is quietly repositioning. It is shifting from just a cross-border payments token into the actual collateral layer of institutional decentralized finance, or DeFi.
That represents a material pivot in strategy. For years, the predominant narrative around XRP was almost entirely about moving value across borders, quickly remittances, and international treasury flows.
The bridge currency idea?
Exactly. But this new vision stretches well beyond that. Edwards noted that they are aggressively pushing activity onto the XRP ledger itself, turning XRP into a source of capital to be lent, borrowed, and used as collateral natively on-chain.
And the mechanism for doing this is outlined in these highly technical GitHub specs we have for a protocol called XLS66. The specs detail how this protocol brings uncollateralized, fixed-term lending natively to the XRP ledger. But I have to ask, how does uncollateralized lending work on a blockchain without it turning into a complete disaster?
It's a fair question.
In the retail crypto DeFi world, platforms require massive over-collateralization because the borrowers are anonymous.
What's fascinating here is how XLS66 completely reimagines DeFi lending for a strictly institutional audience. You are correct that retail DeFi relies on over-collateralization and automated on-chain liquidations. If the market price drops, a smart contract ruthlessly liquidates the borrower's assets to protect the protocol.
Which institutions hate.
Institutions despise that model. It is far too unpredictable for corporate treasuries. They can't wake up at 3 a.m. to find their positions wiped out by a flash crash.
So if they strip away the automated on-chain liquidations, what replaces it?
Real-world institutional lending is predominantly uncollateralized, based on creditworthiness. According to the specs authored by Ripple developers Vitatas Vitotumas and Anchal Malhotra, XLS66 relies heavily on strict off-chain underwriting.
Off-chain.
Right. The blockchain does not care about your credit score, but the loan broker does. The lender has to know exactly who you are, utilizing off-chain KYC and AML checks. The blockchain is used purely for the settlement logic, tracking the ownership of the loan and providing an immutable audit trail.
Even with KYC, defaults happen in the real world. The specs outline a safety net built into the protocol called first loss capital. How does that function as a protective layer?
To protect the depositors who supply liquidity to the lending vault, the protocol requires the loan broker to deposit a protective fund of their own capital. This is the first loss capital.
Like a buffer.
Think of it like a security deposit on an apartment, but on a massive scale. If a borrower defaults on their loan, a portion of that first loss capital is automatically liquidated to absorb the losses, keeping the vault depositors whole.
The broker has real skin in the game. If they underwrite bad loans, their own capital is destroyed first.
Precisely.
That is designed specifically for compliant institutional credit origination. It is about bringing actual credit markets on-chain, not anonymous wallets trading meme coins. So what does this all mean when we put the pieces together? We have the CFTC greenlighting tokenized collateral, Ripple Prime controlling the prime brokerage choke points, and XLS66 enabling institutional lending. How does this macro structure actually impact the value of the assets themselves?
To understand the value impact, we have to look at the macroeconomic math from our source notes. There is a fundamental liquidity equation at play here. Price equals transaction value divided by the product of float and velocity.
Let's break those variables down for the listener. Transaction value would be the total economic demand. Correct. The trillions of dollars in derivatives, margin, and repo markets that want to use this network to move value.
Correct.
Float is the actual supply of the asset available to be purchased or used. And velocity is how fast those assets are moving or changing hands.
That's right. In retail payment networks, money moves incredibly fast. Someone buys a coffee, the merchant pays the supplier pays an employee. The velocity of that money is high.
Right.
But here is the dynamic that flips the traditional crypto narrative on its head. When assets transition into core market infrastructure for wholesale finance, their velocity plummets.
This is the velocity collapse the notes refer to. Why does it plummet? If the pipes are better, shouldn't the assets move faster?
The settlement itself is instantaneous, but the assets are not constantly changing hands. In institutional finance, assets are parked. When XRP or tokenized treasuries are used as native margin collateral, like we saw with the binomial clearinghouse, those assets are locked in clearinghouse pools for the duration of the trade.
Oh, I see.
Furthermore, we have to consider global banking regulations, specifically Basel III and the net stable funding ratio.
I see those regulatory terms thrown around constantly in financial media. What do Basel III and the net stable funding ratio actually mandate a bank to do?
Following the 2008 financial crisis, global regulators implemented Basel III to ensure banks would never run out of cash during a panic again. The net stable funding ratio requires banks to maintain massive liquidity buffers on their balance sheets.
So they have to hoard cash, essentially.
They must hold high-quality liquid assets to cover potential stress events over a one-year horizon. They cannot lend these assets out. They cannot actively trade them. They simply sit in a vault.
So you have billions of dollars worth of these digital assets literally sitting idle as protective reserves or margin collateral. They are removed from active circulation, which means the velocity in our equation drastically drops.
And when we run a macro shock scenario through that equation, the mathematical outcome is severe. Consider a massive liquidity stress event like a yen carry trade unwind.
Walk us through that.
Historically, global investors will borrow cheap yen from Japan, where interest rates have been near zero, and use that cheap money to invest in higher yield assets in the US or Europe.
It is basically picking up pennies in front of a steamroller. It works beautifully until Japan raises interest rates or the yen suddenly strengthens. If that happens, everyone rushes to unwind those trades at the exact same time. Where does that strain show up in the plumbing?
It shows up as a sudden, massive demand for global liquidity. Repo funding tightens, margin calls spike across the board, and collateral must move instantly to prevent hedge funds from collapsing. Returning to our equation, the transaction value, the demand for moving that tokenized collateral across the ledger to meet those margin calls skyrockets into the trillions of dollars.
Let me see if I'm tracking the math here. The demand numerator is exploding into the trillions because of the panic. But the available float and the velocity denominator are incredibly small because those assets are locked up in clearinghouse margin pools and Basel III regulatory buffers. If the top of the fraction explodes while the bottom shrinks, the math only leaves one way out.
The price of the underlying bridge asset must reprice upward structurally. It is a mathematical requirement to support the sheer capacity and transaction volume of the network. The system needs a higher price just to facilitate the movement of that much value when the velocity of the asset is so constrained.
That reframes the entire discussion. It shifts the perspective away from speculation and roots it entirely in utility and network capacity. If a digital settlement layer solves the balance sheet problems of the legacy system, the assets providing liquidity in that system must scale to absorb the flow.
Exactly.
Let's do a quick recap of the journey we've explored today. We started with the December 2025 CFTC pilot program, showing how regulators established the guardrails to bring tokenized collateral into U.S. derivatives markets.
Then we looked at how Ripple is positioning itself at the credit choke points of this new system through their acquisition of Hidden Road. By establishing Ripple Prime as a digital prime broker, they are offering netting efficiency and unbundling the structural risks inherent in the retail exchange model.
From there, we explored the XLS66 protocol on the XRP ledger, which is laying the groundwork for compliant, institutional, uncollateralized lending using that first loss capital protection scheme. And finally, we arrived at the macroeconomic math, the velocity collapse. We saw how locking assets up as institutional collateral forces the value of those assets upward to meet massive transaction demands during global liquidity shocks.
It creates a comprehensive picture of how the back-end wiring of finance is fundamentally evolving.
And for you listening, this is the key takeaway. The true evolution of digital assets isn't happening on flashy retail trading apps with meme coins. It is happening deep within the invisible plumbing of global repo and derivatives markets. The boring, highly regulated infrastructure is what ultimately moves the needle. Now, to wrap up, we want to leave you with a brand new concept to ponder on your own. We had spent this deep dive discussing how tokenized collateral integrates with existing clearinghouses. We are looking at these networks acting as more efficient components within the traditional fiat system. But take that thought experiment one step further.
It presents a fascinating hypothetical regarding the future of financial sovereignty.
If a decentralized ledger, like the XRPL, successfully becomes the ultimate neutral routing layer for the world's wholesale collateral and margin, what does that eventually mean for the sovereign power of central banks? If the actual back-end wiring of global finance outgrows fiat borders and operates on a decentralized, neutral protocol who truly controls the global economy's steering wheel, it's something to chew on until next time. Thanks for joining us for this deep dive.